I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s.
In this video, Jim Rickards delves into several economic indicators and factors affecting the current economic landscape. He mentions significant layoffs in major tech companies like Google, Amazon, and Facebook, yet the unemployment rate remains low. He also criticizes the Phillips curve theory, pointing out inconsistencies in the relationship between unemployment and inflation. He highlights that real wages, adjusted for inflation, have been decreasing despite nominal wage increases. Jim Rickards notes that the Federal Reserve reportedly aims to bring down wage gains further to combat inflation. He also draws attention to the labor force participation rate, indicating a substantial untapped labor pool. The discussion shifts to the US dollar's strength, attributing it to a global scramble for dollars due to a vast off-balance sheet derivatives market valued at approximately $1 quadrillion. In times of economic downturns, banks seek the safety of U.S. Treasury bills, creating a demand for dollars. Jim Rickards predicts a strengthening of the dollar in the face of a potential recession and credit crunch. Jim Rickards suggests that despite seemingly positive economic indicators, there are underlying issues such as a shrinking labor force, decreasing real wages, and a global demand for dollars, which could contribute to a challenging economic environment.
And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah. So your real wage just went down. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population and not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There's a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil in yuan. What do you mean there's a dollar shortage? Well, there is, and we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off-balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. So, okay, what supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. That's what will drive the dollar higher. So they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, et cetera. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it. But what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you for basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage. And that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills, give me a 4-week bill. That's going to drive the dollar higher against basically the euro.
In conclusion, Jim Rickards provides insightful analysis on economic factors, highlighting potential challenges ahead. To stay informed about future discussions and Rickards' valuable insights, subscribe to the channel. Thanks for watching.